Now there's nothing worse, is there, than when you've agreed to buy or sell something at a future date, the other person just doesn't turn up and you're left with no deal. Well, this is exactly what we face in the foreign exchange markets. Now let's just say you're a bank, you've done a deal with one of your customers and you've agreed that in, let's say, 1 month's time, they will give you one currency and you will give them another currency in return. What do you do? Well, what you do is you lay the risk off with another bank. So it's called a back-to-back trade. You've done a trade with your customer, you lay it off with another bank, and between where you buy and sell, that's your profit. But what would happen if the client didn't turn up and didn't deliver their currency? You've got a problem because you still have to honour your trade, honour your hedge with the other bank. So what we need to do in the markets is look at the probability that the client is going to default, and if they do, how much could the market have moved against us? Well, common sense says that if you deal in a currency which is very volatile, you could lose more money, so you'll need a bigger settlement limit. So we need to quantify how much money we could potentially lose. Now, really important, you need to know if you're a customer, if you're a corporate, if you're a treasury, if a commodity price moves or an interest rate moves or a currency moves, how much money could you potentially lose? Now let's take an example here where you have done a deal with one customer on one side, where in return for 10 million euros, you will give them 47.5 million dirhams. Dirhams is a currency used in the United Arab Emirates in the Middle East. What you've done is you go and hedge yourself, you lay the risk off with another bank. Now because it's their birthday, I'm going to do the trade for nothing. So we have 10 million euros in, 10 million euros out, 47.5 million euros in, 47.5 million euros out. It's all square. Now let's just imagine the client goes bust. What if the exchange rate has moved to 465 or to 485 or has just stayed flat? Well, if it stays flat at 475, if I have to replace the defaulted trade in the market, nothing's moved, phew, I'm okay, I don't lose any money. But if that market moves to 465 or to 485, it could make a difference. Now I might be lucky, maybe the market's moved my way and I will make 1 million dirhams profit. But if it's moved against me, I could lose 1 million dirhams. So this is what we talk about with pre-settlement risk, the amount of money we could potentially lose before the trade's done. And that's what the market risk people within a bank will do. They will look at the risk of the markets moving and give you a figure as to how much limit you should put aside.